A stock split is a financial maneuver that publicly traded companies use to increase the number of their outstanding shares while proportionally reducing the share price. While this may sound like corporate jargon, stock splits can significantly impact investors, market perception, and long-term portfolio growth. When a company announces a stock split, it's usually a sign of strong performance. Companies split their stock to make shares more affordable to a broader range of investors, which can boost liquidity and trading volume. This doesn't change the company's market capitalization, the total value of its outstanding shares, but it does make individual shares more accessible. Let's break it down with an example. Suppose you own 100 shares of a company priced at $200 each. If that company announces a 2-for-1 stock split, you will now own 200 shares, but each will be worth $100. The total value of your holdings remains the same, $20,000 before and after the split. Companies most commonly split their stock in ratios like 2-for-1, 3-for-1, or even higher, depending on their growth and market strategies. Occasionally, a company might conduct a reverse stock split, where they reduce the number of outstanding shares, effectively increasing the share price. This is usually done to prevent delisting from major stock exchanges or to make the stock appear more valuable. One of the biggest reasons companies execute stock splits is psychological appeal. When a stock's price climbs too high, retail investors may shy away from buying it. A lower price per share can attract new investors, even though the company's valuation hasn't changed. A classic example is Apple. The tech giant has split its stock multiple times throughout its history. In 2020, Apple did a 4-for-1 stock split when its stock price soared to nearly $500 per share. After the split, shares traded around $125, making it more affordable for investors to buy into the company. Despite the split, Apple's growth continued, and those who held onto their shares reaped long-term benefits. Stock splits also tend to generate positive investor sentiment. Many see a split as a sign of strength, suggesting that the company expects future growth. This can lead to increased demand and a potential price surge over time. However, this is not always the case, and it's important to analyze a company's fundamentals rather than making investment decisions solely based on a stock split announcement. From an investment standpoint, stock splits don't directly create wealth, but they can influence investor behavior. If a stock gains popularity after a split, demand may drive up its price. This effect is often seen in well-known high-growth companies. On the flip side, if a stock splits but doesn't have strong underlying financials, it may not experience significant growth post-split. Another advantage of stock splits is improved liquidity. More shares in circulation mean higher trading volume, which can lead to tighter bid-ask spreads and reduced price volatility. This benefits both institutional and retail investors, making it easier to buy and sell shares without significant price fluctuations. It's also worth noting that fractional share investing has somewhat diminished the necessity of stock splits. Many brokerages now allow investors to buy fractions of a share, meaning that even a high-priced stock like Amazon or Tesla can be purchased in small increments. Despite this, stock splits still carry weight because they enhance a company's appeal to a broader investor base. For long-term investors, stock splits can be an exciting milestone, but they shouldn't be the primary reason to invest in a company. Instead, consider the company's revenue growth, profitability, competitive positioning, and overall industry trends before making investment decisions. If you already own shares of a company undergoing a stock split, there's nothing you need to do. Your brokerage will automatically adjust your holdings to reflect the new share count and price. However, if a stock split piques your interest, take the time to research the company's financials before jumping in. Ultimately, stock splits serve as a psychological and accessibility tool, making shares more attractive to a wider audience. While they don't directly increase your wealth, they can contribute to long-term gains if the company continues to perform well. By understanding the mechanics of stock splits and their potential impact, investors can make more informed decisions and build a strong investment strategy.